Imagine, imagine for a second that you own the ultimate logistical network. Like you don't own any physical products, you don't manufacture a single thing, and you have zero actual inventory.
Right, none at all.
Yeah. Instead, you just own the invisible, highly complex digital plumbing that connects, thousands of suppliers with literally billions of consumers.
Which is the dream business model, honestly.
It is. And for 2 decades, you've been the undisputed master of this network. I mean, you dictate all the terms, you collect this massive steady commission on every single transaction that flows through your pipes, and it just operates with the precision of a Swiss watch.
Until it doesn't.
Exactly, until it doesn't. Because then one day you wake up and you realize the foundational layer beneath your entire business is shifting. The actual company that provides the underlying infrastructure for how people even discover your network, they're starting to build their own pipes.
Yeah, they aren't even attacking your tech directly. They're just slowly redirecting the water before it ever reaches your reservoir.
It's a terrifying prospect.
Yeah.
I mean, you're talking about a scenario where operational excellence suddenly isn't enough anymore. The whole competitive battleground fundamentally shifts from how well you execute to, well, who controls the top of the consumer funnel?
It really is.
Welcome, everyone. Today, we are unpacking a massive stack of financial research, strategy documents, and the absolute latest June 2026 reporting on a company that you have almost certainly used. I mean, you probably have their app installed on your phone right now.
I know I do.
Right. But what exists behind that consumer-facing interface is an absolute behemoth of global commerce. We are doing a deep dive into Booking Holdings. Ticker symbol is BKNG.
And our mission for you today in this deep dive is to explore what I would argue is probably the most fascinating structural tension in the modern market.
The core tension, yeah.
Exactly. Because Booking is, by almost any traditional financial metric, a spectacular business. I mean, it boasts a mathematically verifiable moat. They have incredible capital allocation discipline, and it just generates mountains of free cash flow.
Unbelievable amounts of cash.
Right. But, however, the biggest variables that will dictate its trajectory over the next decade, and we're talking about Google, artificial intelligence, and European Union regulators, those sit completely outside of management's control.
Completely outside.
Yeah. So our goal is to dissect how you can hold both of those seemingly contradictory realities in your head at the exact same time.
Well, before we get into the mechanics of, how they actually make all that money, we really need to clear up some critical housekeeping regarding the reality of 2026. Because if anyone listening pulls up a 5-year stock chart of Booking Holdings right now, you're going to see a line that looks like it drove off a cliff on April 2nd, 2026.
Oh, yeah. It looks brutal if you don't know what you're looking at.
You see this 96% drop in a single day.
Yeah.
Which usually means a company has gone totally bankrupt or committed some massive accounting fraud.
And it's catastrophic, yeah.
Right, but it is purely cosmetic plumbing. Booking executed a 25-for-1 stock split. So a single share that was trading around, $4,100 in late March simply opened at about $164 the next morning.
They just sliced the pizza into 25 much smaller pieces.
Exactly. The underlying value of the enterprise didn't change by a single cent. So as we go through the data today, just understand that all the per-share metrics, earnings per share, dividends, the share price itself, they've all been split adjusted to reflect this new reality.
So if you're reading an old research report from 2024 or something, the per-share numbers are going to be 25 times larger.
Yeah, so always anchor yourself to the market cap, which sits right around $133 billion.
The $133 billion valuation is the anchor here. And to understand why a company without any physical assets commands that premium, we really have to start with the foundational premise of what they actually do.
Which brings us to the Peter Lynch 2-minute test.
Right.
Lynch always argued that if you can't explain a business to a 10-year-old in 2 minutes, you have no business investing in it.
A great rule.
And Booking passes this test flawlessly. I mean, they operate the platform everyone uses to book travel. They don't own the hotels. They don't hire the housekeeping staff. They don't, replace the carpets. They don't fix the air conditioning.
No, they don't touch the physical world at all.
They simply connect a traveler looking for a room with a property owner who has an empty room. And they take a cut for making the introduction.
The premise is super simple, yes. But the execution of that premise is where the true complexity lies. The sheer scale of what they do, it strains comprehension.
Give us the numbers.
Let's look at the final numbers for 2025 to understand the size of this ecosystem. Last year, Booking processed $186.1 billion in gross bookings.
I really want to pause on that number because it's crucial to distinguish between gross bookings and revenue.
Very crucial.
That $186.1 billion, that's the total transaction volume. That is the actual dollar amount of all the hotel nights, the flights, and the rental cars that consumers purchase through their systems.
Correct. So they processed that volume, but they obviously didn't keep it all. Out of that 186.1 billion, Booking recorded $26.9 billion in actual revenue.
Okay, so if you do the division there, it reveals a highly stable take rate of roughly 14.5%.
Right. They capture 14.5 cents of economic value for every dollar of travel they facilitate, which is a phenomenal tax to collect.
And their profitability on that revenue is what really jumps out to me. From that $26.9 billion in revenue, they pulled down $8.8 billion in operating income.
It's massive.
It is. That translates to a structural operating margin of about 33%. And it resulted in $9.1 billion in free cash flow.
$9.1 billion in free cash flow, and the volume metrics underlying those financials are equally staggering. In 2025, they booked 1.24 billion room nights.
Wait, 1.24 billion individual nights?
Yep, billion with a B. That represents an 8% year-over-year growth rate, and they are doing this across 4.4 million properties globally.
That property mix is interesting, too, because it's not just the big global chains, like Marriott or Hilton.
Not at all.
Out of those 4.4 million properties, only about 500,000 are traditional hotels.
Right.
The vast majority, roughly 3.9 million, are alternative accommodations. So we're talking homes, apartments, villas, bed and breakfasts.
And that alternative accommodation segment is vital because it represents highly fragmented supply.
Also,
Well, a massive global hotel brand has the resources to build its own booking engine and loyalty program, right? A family running a 6-room villa in Tuscany does not.
right, they can't afford a massive marketing department.
Exactly. They are entirely dependent on aggregators to find demand. So by capturing 3.9 million of those fragmented properties, Booking embeds itself as the irreplaceable infrastructure for the long tail of global travel.
Operating at a 33% margin at that scale is just wild. To me, it feels less like a traditional service business and more like owning a global air traffic control system.
That's a great way to put it.
Right. You don't have to buy the $200 million Boeing jets. You don't have to pay for the jet fuel. And you don't have to hire the pilots. You just own the communication layer that dictates which plane gets to land on which runway.
And you charge a premium for coordinating the chaos.
Exactly. But maintaining that control tower is getting increasingly expensive, which I think transitions perfectly into how they actually maintain it.
Yeah, we need to look closer at what makes up that control tower, because when we say Booking Holdings, we are actually talking about a holding company that operates 5 distinct brands, each engineered for a specific strategic purpose.
Let's run through the roster. First, obviously, there's the flagship, Booking.com, which is headquartered out of Amsterdam. That's the undisputed global heavyweight.
The cash cow.
Yep. Then you have Priceline, the legacy brand in the U.S. market, which focuses heavily on discount inventory and opaque pricing. Third is Kayak, which operates fundamentally differently. It's a meta search engine that sits at the top of the funnel, aggregating prices from across the web to feed the core marketplaces.
Right, top of funnel.
Then fourth is OpenTable, the restaurant reservation platform, which kind of acts as the connective tissue for the traveler once they actually arrive in a city.
And then there's the 5th brand, which honestly requires our utmost attention today. Agoda.
Agoda, which is headquartered in Singapore. And looking through the analyst coverage, it seems like most U.S.-based financial media almost completely ignores it.
They absolutely do.
They talk endlessly about Booking.com and Priceline, but Agoda is treated like an afterthought.
Which is a massive, massive analytical blind spot. Most U.S. analysts just chronically undercover Agoda, but it is the absolute engine capturing the migration of emerging markets to online travel.
It's the growth driver.
If you were looking at the next decade of growth, you have to look at the Asia-Pacific region.
Let's explore the mechanics of why that is, because when we talk about emerging markets, countries like Vietnam, India, Brazil, Indonesia, we are looking at massive populations where a rising middle class is reaching an income threshold that makes international leisure travel possible for the first time.
Exactly. And when a family in Mumbai or Ho Chi Minh City plans their first international vacation, they are rarely typing Booking.com into a desktop computer.
Right.
They are using a mobile device and they are opening the Agoda app. Agoda has spent years building localized infrastructure that Western analysts just overlook.
What kind of infrastructure?
Well, they've integrated regional payment rails, things like GrabPay, Alipay, and localized bank transfers, which are essential in underbanked regions. And they've secured deep, localized supplier networks across Southeast Asia. They essentially own the digital on-ramp for the single largest pool of new travelers entering the global market.
So if I'm a competitor, say Expedia, why can't I just launch a localized app in Vietnam tomorrow, translate it into Vietnamese, and start competing? What stops them from just copying the interface?
Because the interface is just the paint on the walls, the actual competitive advantage lies in the database architecture beneath it.
The plumbing.
Yes, the plumbing. The source materials are very explicit about a technical reality that kind of shatters how most people view these platforms. Booking is emphatically not a search engine.
I want to dig deeply into this because it changed my entire mental model reading the sources. I always assumed Booking.com was just a really efficient search engine for hotel rooms. You type in Paris, it scrapes the internet, and it shows you what's available.
That assumption is super common, but it is technically backward. A search engine like Google or Yahoo performs a read operation.
A read operation.
Yeah, it sends out crawlers, reads public information existing on third-party servers, and displays a copy of that information to you. If you search for a local bakery on Google, Google tells you they're open until 6 p.m. But Google doesn't interact with the bakery's cash register. It just points you in their direction.
Right, it's totally passive, like looking at a restaurant menu through the window.
Exactly. Booking, however, performs a write operation. They are writing data directly into the central nervous system of the hotel.
Let's break down what that actually means when a transaction happens. I'll try a mechanical analogy here. A travel search engine is like a digital billboard. It shows you the price of a flight or a room, but when you click it, it kicks you over to the airline or the hotel's website to actually buy it.
Right.
But what Booking does is more like walking directly into the kitchen, reserving a specific cut of meat, charging the customer's card, and telling the chef exactly when the customer will arrive.
That's a perfect analogy. Let's trace the exact life cycle of a transaction to illustrate this. When a user in London clicks Confirm Booking for a property in Tokyo, a staggering sequence of technological events must happen in fractions of a second.
Okay.
First, booking servers reach directly into the hotel's property management system, the PMS.
And the PMS is the actual software the hotel staff uses to assign rooms and print key cards at the front desk.
Exactly. Booking accesses that system via an API and executes what database engineers call an atomic lock on that specific room inventory.
Atomic lock meaning it freezes the asset?
Yes. It guarantees concurrency. It ensures that in the 200 milliseconds it takes to process the payment, no other channel, not Expedia, not a walk-in guest, not the hotel's own website, can double book that same room.
Wow.
Once the lock is confirmed, Booking Stack processes the financial transaction. Then they push the actual reservation details, the guest's name, their loyalty status, their dietary requests directly into the hotel's operational queue. Finally, they trigger the automated notifications to the housekeeping software and the channel manager.
It fundamentally changes the relationship. They aren't a marketing affiliate sending leads. They are functioning as outsourced digital operations for the property.
And achieving that level of integration is brutally difficult.
Right.
We're talking about connecting to hundreds of highly fragmented PMS providers globally.
Right, because not everyone uses the same software.
Exactly. Some hotels use modern cloud-based systems like Oracle Opera, but others use 20-year-old on-premise servers in the basement of some boutique hotel. Building certified, secure, two-way read-write integrations into that kind of fragmented legacy infrastructure, it requires thousands of person-years of engineering and localized contracting.
You cannot just buy your way into that with a massive marketing budget. It takes decades of trench warfare.
Decades.
Understanding that deep integration is the perfect primer for what is arguably the most important financial shift happening inside the company right now. The way the money flows is changing aggressively. Our sources detail a massive structural migration from the agency model to the merchant model.
This shift is the hidden engine driving their current capital structure.
Break down the traditional agency model for us first, just so we have a baseline.
So under the agency model, Booking acts purely as an introducing broker. You go to Booking.com, you reserve a room for a trip 3 months from now, and you enter your credit card to hold the reservation. But Booking does not charge you. When you eventually travel, you arrive at the hotel, you hand your physical credit card to the front desk, and the hotel charges you directly. At the end of that month, Booking sends the hotel an invoice for their 14.5% commission.
It's a very clean model. Booking takes zero credit risk and handles very little actual money. But they're moving away from it.
They are moving away from it at breakneck speed. They are transitioning to the merchant model.
Okay.
Under this system, Booking is the merchant of record. When you click Book, Booking charges your credit card immediately. They collect the full payment upfront. Then, months later, after you have actually completed your stay, Booking remits the funds to the hotel, minus their commission.
The data on this transition is staggering. Let's look at the 2025 financial disclosures. In 2025, merchant bookings reached $130 billion,
$130 billion.
which was a 24.8% increase year over year. Meanwhile, the legacy agency bookings actually shrank, dropping to $56.1 billion, which is an 8.7% decline. So in the span of 12 months, the merchant share of their total business jumped from 67% to 72%.
They are forcibly rewiring how $130 billion of global travel capital moves.
And the financial byproduct of rewiring that capital flow is the creation of immense float. This is a concept heavily popularized by Warren Buffett.
Oh yeah, Buffett loves float.
Right. Buffett built the Berkshire Hathaway empire largely by exploiting float within his insurance subsidiaries.
A quick quote about float from Buffett.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
Geico collects your auto insurance premium in January, but they might not have to pay out a claim to a body shop until November. For those 10 months, Geico gets to invest that cash and keep the profits.
That is the exact mechanism here. Float is defined as money that a company holds on its balance sheet but does not actually own. Booking has essentially built a travel industry version of an insurance float pool.
It makes total sense.
If a traveler books a non-refundable summer vacation in February, Booking collects the cash instantly. But they do not pay the resort in Spain until the guest checks out in July. For 5 months, Booking is holding billions of dollars of idle cash.
And when you aggregate that across $130 billion in merchant volume, the numbers just get absurd. By the end of 2025, the balance sheet showed a deferred merchant bookings pool, which is the official term for this float, of $5.27 billion.
$5.27 billion just sitting there.
And that pool expanded by $1.24 billion in just 1 year.
It is functionally a massive interest-free loan from their customers.
My immediate thought looking at that is the yield. If I have $5 billion of someone else's money sitting in my corporate treasury for 6 months, I am going to buy short-term treasury bills or commercial paper and earn a massive risk-free return on it.
Oh, they absolutely do.
Of course.
However, this is where macroeconomic reality imposes a strict limit on the model. The float pool is structural and it's growing, but the yield they generate from it is entirely dependent on global central bank policy.
Right, interest rates.
We saw this vulnerability materialize clearly between 2024 and 2025.
Let's run the math on that interest income, because the drop is noticeable.
In 2024, when global interest rates were significantly higher, Booking generated $1.11 billion simply from the interest and dividend income on that float.
Over $1 billion of nearly pure profit just for holding cash.
But moving into 2025, central banks began easing rates. Because of that easing, even though their actual pool of float grew by over $1 billion, the yield they earned on it shrank. In 2025, their interest and dividend income fell to $921 million.
So it's roughly a 17% decline in interest income, despite having way more principal to invest. It proves that while float is a fantastic accelerant, you can't underwrite it as a perpetual high-growth revenue stream.
No, you are totally at the mercy of the Federal Reserve and global central banks.
Still, Peter Lynch would absolutely love this dynamic. It's the ultimate example of what he called negative working capital.
Lynch loved negative working capital businesses because they can grow without needing massive external financing.
A company like Costco is the classic example, right? You pay Costco for your annual membership up front, and when you buy a television, you pay Costco that day. But Costco doesn't pay Sony for that television for another 30 to 60 days. The suppliers are funding the growth.
Booking operates the exact same way.
But the sources also highlight a secondary and perhaps more powerful strategic reason for this merchant shift. It isn't just about harvesting interest yield. It's about building a second-order moat around the hotels.
This is the operational brilliance of the merchant model. It fundamentally deepens the switching costs for the supplier.
Okay, let's unpack that.
Under the old agency model, a hotel viewed Booking simply as a marketing channel. If the hotel decided the 14.5% commission was too high, They could simply turn off their Booking.com inventory, lose the leads, and try to find guests elsewhere. The operational friction of leaving was pretty low.
But the merchant model changes that friction.
It changes it entirely because Booking embeds itself into the financial operations of the property. When Booking is the merchant of record, they are handling the credit card processing fees. They're managing the immense foreign exchange risk.
Oh, right. When a traveler pays in Japanese yen, but the hotel needs to be paid in Thai baht.
Exactly. Booking handles that. They operate the fraud detection and chargeback defense algorithms. They even calculate and remit local occupancy taxes in thousands of varying municipal jurisdictions.
So if a hotel decides they want to leave the platform, they aren't just turning off a marketing pipe. They have to suddenly figure out how to process international payments, absorb fraud liability, and handle multi-currency accounting.
Which is a massive operational deterrent. The switching costs transition from being purely revenue-based to deeply operational. It locks the supplier into the ecosystem on Booking's rails.
We've used the term moat several times now, which leads us to stress testing exactly how deep this moat actually is. The sources apply Hamilton-Helmer's incredibly rigorous 7 powers framework to evaluate Booking's true structural advantages.
Helmer's framework is arguably the most stringent diagnostic tool for strategic moats out there. It dismisses vague concepts like great management or first-mover advantage and focuses strictly on mathematical, durable barriers to entry.
Helmer defines 7 distinct powers. Let's evaluate Booking against them. Let's start with power number 1, network economies.
This is their strongest power, no question. Network economies exist in two-sided marketplaces where the value of the platform increases for everyone as more participants join.
Like a telephone network.
Exactly. Booking has 4.4 million properties, which attracts a massive volume of travelers. That immense traveler demand, in turn, forces every new hotel that opens to list on Booking to access those guests. It is a virtuous reinforcing cycle that is incredibly difficult for a subscale competitor to break.
Power number 2, scale economies.
Also extremely strong. Scale economies occur when fixed costs are amortized over a massive volume of units. Booking has $186 billion in gross bookings to spread its operational costs across. Think about the cost of maintaining 247 customer service centers in 40 different languages, or building state-of-the-art machine learning algorithms for fraud detection. A regional OTA with only $2 billion in bookings simply cannot afford to match that infrastructure on a per-transaction basis.
Booking's massive scale allows them to outinvest smaller competitors while maintaining higher margins.
Precisely.
Power number 3, switching costs.
This is where the analysis becomes nuanced. Booking possesses partial switching costs. As we just discussed regarding the merchant model, the switching costs are very high on the supply side. The hotels are operationally locked in.
But on the demand side.
Exactly. On the demand side, the dry travel is sad. The switching costs are practically zero. There is no friction preventing a consumer from opening Expedia, Airbnb, or Google Flights for their next trip.
What about the remaining 4 powers? Branding, process power, cornered resources, and counterpositioning.
If we are being academically strict, Booking lacks them.
Really? Even branding?
They obviously have brand awareness, but Helmer defines branding specifically as the ability to charge a sustained premium price over an identical generic offering, which Booking cannot dictate to the consumer.
Fair enough.
They don't have cornered resources like an exclusive patent or a captive regulatory license. They have excellent operations, but not structurally uncopyable process power. And as we will explore shortly, they definitely do not possess counterpositioning. So the final grade is 2 strong powers, 1 partial power, and 4 absent.
It's a formidable business, but the moat has structural limitations. Which brings us to another classic analytical tool mentioned in our sources, Pat Dorsey's $10 billion test.
Dorsey's test is a fantastic thought experiment. The premise is simple. If I handed you $10 billion in unrestricted cash and allowed you to recruit the absolute best software engineers on the planet, could you build a business that destroys the incumbent's moat and steals their market share?
Okay, let's play the game. I have $10 billion. I hire the top talent out of MIT and Stanford. Could I dismantle Booking's business?
If you are operating as a traditional startup, the answer is definitively no. Your $10 billion would be incinerated.
Why? I have $10 billion.
Because building a beautiful, lightning-fast app might only cost you $20 million, but $10 billion cannot compress time. It cannot instantly purchase the localized contracting relationships with 4.4 million property owners.
Right.
It cannot instantly replicate the thousands of person-years required to code, test, and maintain certified API integrations into hundreds of fragmented legacy property management systems. The moat is impenetrable against a well-funded startup.
The technical debt and relationship capital are just too high.
Exactly. It passes the test against a startup. But Dorsey's test assumes the attacker is starting from zero. What happens if the attacker isn't a startup?
What if the attacker already has infinite capital, already employs the best engineers, and crucially, already controls the entry point for every traveler on the internet?
We are talking about Google.
Yes. The existential threat to Booking Holdings is not a startup in Silicon Valley. It is Google.
And this is where the dynamic gets really uncomfortable.
Let's look at the customer acquisition funnel, because the financial reporting paints a very disturbing picture of this dependency. Booking's single largest operating expense line isn't their servers, and it isn't their payroll. It is marketing.
Yep.
And their marketing spend increased from $7.3 billion in 2024 to $8.2 billion in 2025.
The vast majority of that $8.2 billion is performance marketing, paid search keywords.
They are essentially paying billions of dollars a year directly to Google to acquire customers. They are feeding the very beast that possesses the capability to disintermediate them.
The largest expense paid to their largest strategic risk, which leads us to the January 2026 announcement from Google that fundamentally alters the risk profile here. Google introduced something called UCP, Universal Commerce Protocol.
Let's define that.
Universal Commerce Protocol is a profound shift in digital infrastructure. At its core, UCP is a protocol designed to allow commercial transactions to be completed entirely within Google's own native surfaces.
So within a Google search results page, or inside Google Maps, or through Gemini.
Exactly.
The key phrase there is without redirecting.
That is the whole point. For 20 years, the internet economy has operated on a redirect model. You search for hotels in Rome on Google. Google shows you an ad for Booking.com. You click the ad, Google collects a fee, and you are redirected to Booking's website where you actually choose your room and enter your credit card.
Google was just the toll road leading to Booking's store.
But under UCP applied to travel, Google wants to own the store as well. They want to trap the consumer inside the Google ecosystem.
Yeah.
You search for the hotel, you view the pictures, you select the dates, and you process the payment via Google Pay, all without ever leaving the Google search page.
Earlier, we discussed Helmer's 7 powers and noted that Booking lacks counterpositioning.
Yeah.
The sources argue that Google is actually weaponizing counterpositioning against Booking right now. Walk us through how that works.
Counterpositioning is arguably the most lethal strategic advantage because it traps the incumbent in a paradox. A business possesses counterpositioning when it adopts a new, superior business model that the incumbent cannot copy without cannibalizing its own core business.
Okay, I follow.
Google does not rely on online travel agencies to survive. Google generates hundreds of billions from search, cloud, and broader advertising. But Booking relies entirely on the travel transaction. If Google decides to change the paradigm and execute transactions natively, Booking cannot respond by trying to build a rival search engine to compete with Google.
That path is economically impossible. Booking is structurally trapped by Google's move.
Exactly. They are counterpositioned.
I have to offer some pushback on this, though, going back to the digital plumbing we discussed earlier.
Go for it.
Even if Google successfully traps the user inside search and takes their credit card, Google still doesn't possess the operational backend. Google hasn't spent 20 years building atomic lock APIs into the legacy property management systems of 4.4 million hotels. Doesn't Google ultimately still need Booking's infrastructure to actually fulfill the right operation and tell the hotel the guest is coming?
The mechanics are even more complicated than that, but your core premise is absolutely sound. Yes, Google does not want to deal with the operational nightmare of localized PMS integration, handling hotel customer service, or managing localized taxation.
You just want the ad revenue and the consumer data.
So the likely outcome isn't that Google replaces Booking's technology. The likely outcome is that Booking is relegated to being a silent fulfillment partner.
A silent pipe in the background.
Precisely. The transaction happens on Google, and Google routes the fulfillment request through Booking's API via the backend. But think about how that completely destroys Booking's economic leverage.
No, because they lose the customer relationship.
If Google controls the consumer relationship and the interface, Google gets to dictate the terms of trade. Booking loses its pricing power. Instead of dictating a 14.5% take rate to the hotel, Booking is suddenly forced into a wholesale bidding war against Expedia, Agoda, and the hotel's own direct systems, just to provide the cheapest back-end fulfillment for Google's customer.
The volume of transactions might still flow through Booking's pipes, but the margin they can extract from that flow will be violently compressed.
It turns a high-margin software business into a commoditized utility provider. That is the nightmare scenario.
And sitting right next to Google UCP in the risk column is the rapid evolution of artificial intelligence. Everyone is theorizing about AI agents booking travel.
It is the great speculative unknown, and we actually have tangible 2026 data on how the incumbents are trying to front-run this disruption. On June 3rd, 2026, Priceline, which is a booking holdings brand, upgraded their AI assistant, Penny, to be fully agentic.
Let's define agentic for clarity. An agentic AI isn't just a chatbot that answers questions based on a large language model. It has the authorization to take autonomous actions on your behalf.
Exactly. Penny is built on Anthropic's Claude model. It doesn't just suggest a hotel in Miami. It can access the APIs, plan the itinerary, physically book the flights and hotel rooms, process the payment, and later modify or cancel the reservation, all through conversational prompts.
It feels like they are cannibalizing their own traditional search interface before a startup can do it to them.
That's the strategy.
But is the consumer behavior actually shifting? Are we seeing AI definitively displace traditional search and click bookings?
Here is where the data diverges from the narrative hype. Despite the immense capabilities of models like Gemini and Claude, the financial reporting through mid-2026 shows absolutely zero material displacement in booking volume.
Zero.
Essentially zero. Travelers are certainly using AI to brainstorm itineraries or ask about visa requirements, but when it comes time to enter a credit card for a $3,000 non-refundable family vacation, the vast majority of consumers still prefer the visual control and trust of a traditional OTA interface.
That makes sense. I want to see the pictures of the pool myself.
Exactly. AI is an undeniable looming threat, but right now it functions more like an alternative access point to the same underlying digital plumbing, rather than a total replacement of the business model.
It's an interface evolution, not a structural collapse yet.
Right.
Now, moving away from technological threats, we have to look at the regulatory environment, specifically the actions coming out of Brussels. Because the European Union has historically been booking's strongest and most profitable market, but the legal foundation there is cracking.
The regulatory landscape in the EU fundamentally shifted against them under the Digital Markets Act, or DMA. Booking was officially designated a gatekeeper platform.
What are the immediate consequences of that gatekeeper label?
The most devastating consequence was the forced unwind of price parity clauses across the entire European Economic Area.
I want to unpack parity clauses, because this is the legal mechanism that historically enforced their pricing power.
It was their shield.
Right. A price parity clause was a contractual rule where Booking told a hotel partner, if you list a room on Booking.com for 200 euros, you are legally prohibited from offering that exact same room on your own hotel's website for 180 euros. You must maintain price parity with us.
The parity clause was the ultimate defense mechanism. It guaranteed to the consumer that they would never find a cheaper price by bypassing the OTA and booking direct. But the European Commission ruled that this was anti-competitive behavior by a gatekeeper.
So those clauses have been struck down.
Struck down entirely. Now, a hotel in Paris or Berlin can legally leverage Booking.com for visibility, but explicitly offer a 10% discount to travelers who book directly on the hotel's own website.
It effectively turns Booking.com into an unpaid billboard for the hotel.
It does.
And it's not just a forward-looking issue. The sources note a massive class action lawsuit currently moving through the European courts involving over 10,000 hotels seeking historical damages for the profits lost during the years those parity clauses were enforced.
It introduces massive legal tail risk to the balance sheet and permanently degrades their ability to enforce pricing discipline in their most crucial geographic market.
We also have to layer on the inherent macro vulnerability of the sector itself. Travel is a highly cyclical, discretionary industry. When the broader economy falters, travel is the very first line item cut from a household budget. You don't delay buying groceries, you delay the trip to Hawaii.
The structural fragility of travel was laid bare in 2020. That was a near-extinction event for the sector.
Booking's top-line revenue collapsed by 55% in a single year.
And their net income evaporated by 99%. Management was forced to execute emergency debt offerings, raising $4 billion just to ensure the company had enough liquidity to keep the servers running.
We're seeing echoes of that sensitivity in the recent data. The Q1 2026 earnings report showed a minor but statistically significant headwind to global room night growth, driven entirely by geopolitical conflict in the Middle East.
It proves that no matter how good the digital infrastructure is, the business is ultimately tethered to physical world stability.
Quick break. This show is built on the fundamental research of Yehonatan, our lead analyst and founder. Want his tools? Click the Substack link below to get 3 free resources for this company. The full deep dive PDF, an interactive valuation model to test your own growth and discount rate scenarios, and a 20-year financial spreadsheet, all completely free. Now back to the numbers.
So we have spent the first half of this analysis systematically dismantling the security of the business.
We really have.
We have Google threatening to hijack the top of the funnel and turn them into commoditized plumbing. We have AI agents threatening to disintermediate the search interface. We have EU regulators legally dismantling their pricing power. And we have the inherent cyclicality of global travel.
Sounds pretty bleak.
Right. So the logical question is, if the moat is under assault from multiple vectors, why on earth is the market still placing a $133 billion premium on this equity? Where is the growth narrative?
This is the perfect pivot to the other side of the core tension. The threats are real, but the growth engines powering the business are undeniable, and they are moving at a velocity that forces investors to stay engaged. Give this some real airtime, because our sources break down 3 distinct engines of growth.
Starting with the sheer macroeconomic tailwind. Engine number 1, income elasticity.
Income elasticity is a fundamental economic concept that explains how consumer behavior changes as wealth increases. A good with high income elasticity means that as a household's income rises, they spend a disproportionately larger percentage of that new wealth on that specific category.
And travel fits that bill perfectly.
Travel is perhaps the ultimate high income elasticity good. When a family moves from working class to middle class or middle class to upper middle class, their spending on staples like toothpaste or bread increases marginally, but their discretionary spending on leisure travel expands exponentially.
The World Travel and Tourism Council, the WTTC, released their 2026 projections, and the data clearly illustrates this compounding effect. Travel is currently a $12 trillion contributor to global GDP.
$12 trillion.
Trillion with a T. And crucially, the WTTC projects the travel sector will grow at 3.2% in 2026.
Why is that specific number vital? Because the wider global economy is only projected to grow at roughly 2.4%. The travel sector is structurally outpacing overall economic growth.
It's eating a larger share of the pie. The data shows travel currently makes up 9.9% of global GDP, and it is projected to hit 11.5% by 2035. They project the sector will grow at an annualized rate of 3.6% through the next decade, which is roughly 1.5 times the growth rate of the broader economy.
Think about what that means. If Booking Holdings executes 0 new strategic initiatives, if they simply maintain their current baseline market share, the sheer physics of macroeconomic expansion dictates that they will grow faster than the average company in the S&P 500.
But they aren't just passively riding the macro wave. They are actively capturing market share through the digitization of the industry. This brings us to engine number 2, online penetration.
It is a common cognitive bias for investors sitting in North America or Western Europe to assume that the transition to digital booking is complete.
Right, we do everything on our phone, so we think everyone does.
We book everything online, so we assume the world does. But the global reality is that only about half of all global accommodation volume is currently transacted online. Roughly half. In emerging markets across Asia, Latin America, and Africa, the digital penetration rate is significantly lower. There is a multi-decade runway of existing physical inventory that is simply coming online for the first time.
The pace of that onboarding is evident in their supply growth. From 2024 to 2025, they increased their property count from 4.0 million to 4.4 million.
They successfully integrated 400,000 new properties into their digital infrastructure in 12 months.
And we see the result in the volume metrics. Their room nights booked grew by 8% year over year. The baseline growth for the broader travel industry was only about 3%. That 500 basis point spread between the industry growth and bookings growth represents pure, unadulterated market share capture.
And we must return to Agoda here.
We have to mention Agoda again, yes.
Agoda is the primary net capturing that offline to online migration across the Asia-Pacific corridor. It is the engine driving that outsized volume growth in regions where online penetration is still in the early innings.
So we have the macro tailwind of global wealth expansion, and the structural tailwind of offline to online migration. That leads to engine number 3, which is an internal strategic initiative that management has been touting for years: the connected trip.
The connected trip has been a staple of Booking's corporate presentations for nearly a decade. For a long time, analysts dismissed it as buzzword bingo.
Corporate jargon.
Exactly. The theory was simple. Stop treating the customer as a single, isolated transaction for a hotel room. Instead, capture the entire travel life cycle.
You use the platform to book the flight, which naturally leads to booking the hotel, which seamlessly prompts you to reserve the rental car, and eventually integrates with OpenTable to secure dinner reservations upon arrival.
The holy grail of cross-selling. The question has always been whether they could actually execute it beyond the hotel room. But the 2025 and early 2026 data finally proves that it is working, specifically in the aviation vertical.
Let's look at the airline ticket volume. In 2024, they processed 49 million flight tickets. In 2025, that volume exploded to 68 million tickets.
That is a 37% year-over-year increase.
And the momentum didn't stall. In Q1 of 2026, flight volume grew an additional 28.5%. When you are growing a segment at nearly 30% on a base of tens of millions of units, that is massive strategic validation.
It proves that they are successfully training the consumer to view Booking.com not just as an accommodation provider, but as a holistic travel agency. However, we must remain objective because the connected trip strategy is encountering significant friction in other verticals. Look at the rental car data.
The car rental segment paints a very different picture. It's what I would call an honest deceleration.
Honest is a good word for it.
In 2025, rental car days increased from 83 million to 88 million, which is a modest 6% growth rate. But in Q1 of 2026, the volume actually contracted. It went negative, dropping 4.9%.
Management attributed the contraction to a combination of higher daily rental rates suppressing demand and specific geopolitical disruptions in localized markets. But structurally, it highlights why cars are more difficult than flights.
Explain that difference.
Well, airline inventory is globally standardized through central reservation systems. Rental cars are hyper-localized, physical fleets subject to local supply chain constraints, depreciation, and localized pricing wars. It demonstrates that while the connected trip is a valid growth engine, it will not compound uniformly across all verticals.
Cover both the massive flight growth and the car deceleration, and you get a real picture. So we have the ultimate analytical standoff. On one side, profound structural threats from Google, AI, and regulators. On the other side, highly resilient, mathematically proven engines of macroeconomic and market share growth.
So how does the market synthesize these conflicting realities? How do you actually value this enterprise?
To approach the valuation of a business with this specific risk profile, we have to look through the analytical lens of Seth Klarman.
Oh, yes.
I have to pause for a second because the mythology around Seth Klarman is fascinating. For anyone unfamiliar, Klarman is one of the most revered value investors of the modern era. In the early 1990s, he published a book outlining his philosophy titled Margin of Safety. But it has been out of print for decades, and the cult following around it is so intense that a used, dog-eared paperback copy currently sells for roughly $1,700 on Amazon.
The secondary market price for the book is absurd, honestly.
Yeah.
But the intellectual framework inside it is invaluable for our current analysis. Klarman's core tenet is an inversion of how most retail investors think.
How so?
Most people look at a stock price and ask, what is this company fundamentally worth? Klarman argues that is the wrong question because valuation is subjective. Instead, you must look at the current market price and ask, what specific future scenario is this price embedding? What growth rates and risks is the market already assuming will become reality?
Let's apply that inversion to Booking Holdings. As of mid-2026, the stock is trading at a PE, or price to earnings, ratio of roughly 22.6x.
Which is the critical data point. If we look at the historical context, Booking's 10-year median PE ratio sits much higher, right around 31x.
And furthermore, their PEG ratio, a metric championed by Peter Lynch that measures the PE ratio against the expected earnings growth rate, is currently hovering right around 1.0.
A PEG ratio of 1.0 generally suggests the stock is fairly valued relative to its near-term growth generation. But that massive multiple compression dropping from a historical average of 31x down to 22.6x tells a very clear story.
The broader market is actively discounting the equity.
Exactly. Investors are looking at the Google UCP threat, the AI agent disruption, and the EU regulatory changes, and they are demanding a significantly lower entry price to absorb those systemic risks.
The 22.6x multiple is the market's attempt to price in the tension. So to follow Klorman's methodology, let's run through 3 high-level scenarios of how the next 5 to 10 years could unfold and see which one aligns with the current price.
Right, and we won't generate specific DCF or discounted cash flow, dollar outputs, or arbitrary price targets, but we need to understand the narrative probabilities.
Let's outline scenario 1, the bull case.
In the ultimate bull case, the defensive walls hold and the growth engines accelerate. The connected trip strategy continues its flawless execution, with flight bookings crossing the 100 million ticket threshold.
Agoda successfully doubles the online penetration rate across the Asia-Pacific emerging markets.
Yes, the AI threat fails to disintermediate the interface. Instead, AI agents simply become a back-end convenience feature that still relies on and pays for Booking's API inventory. Crucially, Google's Universal Commerce Protocol is rolled out, but regulatory scrutiny prevents Google from fully trapping the transaction, relegating UCP to a minor customer acquisition cost headwind rather than a structural collapse.
Under this scenario, revenue continues to compound and free cash flow grows steadily at 12 to 14% annually through the end of the decade.
If that scenario materializes, the current 22.6x multiple is demonstrably cheap. But we must evaluate the middle ground. Scenario 2 is the base case.
The base case assumes a muddled reality. The WTTC macro projections hold true, and travel continues to outpace global GDP. Booking maintains its market share, successfully capturing the offline to online shift.
However, the cost of defending that market share escalates brutally. Google UCP gains traction, forcing Booking to spend billions more in performance marketing just to maintain top-of-funnel visibility.
The rising customer acquisition costs entirely consume any operational leverage. The operating margin stagnates at 33%, failing to expand. They remain a massive, highly profitable enterprise, but the moat is perpetually contested and cash flow growth moderates to mid-single digits.
That base case narrative is realistically what the current 22.6x PE ratio implies. The market is pricing in survival and moderate growth, but zero margin expansion due to the structural threats.
And then there is scenario 3, the bear case. The nightmare scenario where the fault line ruptures.
In the bear case, the structural vulnerabilities are fully exploited. Google's Universal Commerce Protocol works flawlessly, completely trapping the consumer inside the Google Search and Gemini ecosystem.
Booking is permanently relegated to being one of several invisible, commoditized fulfillment pipes operating in the background.
Because Google owns the customer, Google dictates the economics, forcing Booking's 14.5% take rate down by 100 to 200 basis points. Simultaneously, EU regulations empower hotels to aggressively undercut OTA pricing, further eroding the value proposition.
Top-line revenue growth stalls out entirely. The massive marketing spend required to fight back destroys functions, and free cash flow growth flatlines, potentially turning negative in the back half of the decade.
If you are holding the stock, that scenario is terrifying because it means the multiple has much further to fall.
And listeners, I want to explicitly emphasize this point. You do not have to accept our generalized scenarios. We've linked an interactive valuation tool directly in the show notes. I strongly encourage you to open it and test these variables yourself.
It's a fantastic tool.
You can adjust the projected impact of the Google UCP rollout, alter the assumed growth rates for emerging market penetration, and immediately see how those changing assumptions fundamentally alter the implied valuation of the enterprise.
Using the tool is a vital exercise because it forces you to quantify your assumptions about external threats that are inherently difficult to measure.
Which brings us to the ultimate conclusion of our analysis today. We always end our deep dives by bringing the theoretical frameworks back to the practical reality of portfolio construction. We call it the mirror test.
The mirror test requires absolute intellectual honesty. You stand in front of the mirror and you ask yourself, if I allocate capital to this business, can I articulate exactly why on a single piece of paper? And if the equity price drops by 40% next month due to a macro shock or a Google announcement, do I understand the underlying mechanics well enough to confidently decide whether the thesis is broken and I should sell, or whether it is a market overreaction and I should aggressively buy more?
For Booking holdings, writing out that single page of paper ultimately boils down to underwriting 6 very specific bets. We can distill this entire hour of analysis, the core tension of the $133 billion giant, into these 6 propositions.
3 of those bets reside comfortably within your analytical circle of competence, and they are heavily supported by historical data.
Bet number 1. You believe global travel demand will continue its structural outperformance relative to global GDP.
Bet number 2. You believe the offline to online migration, particularly driven by Agoda and emerging markets, has years of runway remaining.
Bet number 3. You believe the operational integration of the merchant model has permanently deepened the switching costs, ensuring hotel suppliers cannot easily abandon the platform.
Those are the bets on management's execution. But to hold this equity, you are simultaneously making 3 massive bets on forces entirely outside of management's control.
Bet number 4. You are betting against the widespread successful adoption of Google's Universal Commerce Protocol, trapping the transaction.
Bet number 5. You are betting that Anthropic, OpenAI, and the broader shift toward agentic AI will fail to disintermediate the consumer interface.
Yeah, and bet number 6. You are betting that regulators in Brussels, and potentially globally, will not find new legal mechanisms to further erode the company's pricing authority.
If you can evaluate those 6 bets, assign probabilities to them, and feel comfortable with the resulting risk profile, then you possess a genuine understanding of the business. If you cannot, then you are simply gambling on a ticker symbol moving upward on a screen.
And that is why I'm reminding you for the second time. Go click the link for the interactive tool in the notes, build your own conviction model, adjust the slider on the Google threat, and watch what it does to the terminal value. It is the only way to transition from passively consuming financial information to actively mastering the mechanics of valuation.
True financial knowledge only compounds when it is actively applied.
Let me leave you with one final provocative thought to chew on regarding the future of this company. We have spent an hour detailing how their entirely digital, asset-light moat is being slowly commoditized by even larger digital aggregators like Google and AI models.
A real threat.
If the digital interface is no longer a defensible fortress, does a company like Booking Holdings eventually have to pivot into the physical world?
Oh, that's an interesting thought.
In a future where digital aggregation yields zero pricing power, will they be forced to vertically integrate? Will we wake up in 2030 to read that Booking has used its massive free cash flow to outright purchase a global hotel chain or buy an airline fleet, simply to secure proprietary physical resources that an AI algorithm cannot easily scrape and replicate?
It's a radical departure from their history, but survival often demands radical evolution. It is a fascinating strategic question that strikes at the heart of where the internet economy is heading.
Now, before we sign off, I need to drop a massive tease for our next deep dive. We have received an overwhelming number of requests for this specific company. For episode 10, we are aiming our analytical frameworks at SpaceX.
That conversation is going to seriously test the limits of our traditional valuation models.
It absolutely will.
Yeah.
Now, we acknowledge upfront that SpaceX is not a publicly traded entity in the S&P 500, but we are covering it by popular demand because we are looking ahead to the highly anticipated June 2026 IPO of their Starlink division.
It's going to be huge.
We're going to take this literal rocket ship of a business, a once-in-a-generation engineering marvel, and relentlessly examine its unit economics through the disciplined, grounded value lenses of Warren Buffett and Peter Lynch. It is an exploration of whether industrial exceptionalism translates into durable shareholder value, and you will not want to miss it.
I am already looking forward to it.
So, as you go about the rest of your day, think back to the architecture of the digital economy. If you own the most efficient logistical pipes in the world, but your biggest competitor controls the reservoir, well, who truly controls the flow of capital? Thanks for joining us on this deep dive. See you next time.
If you enjoyed today's analysis, make sure to follow the show on your favorite podcast app so you never miss an episode. As a reminder, this podcast is for informational and educational purposes only and does not provide financial, investment, or legal advice. Investing involves risk, and you should always do your own fundamental research and consult a qualified professional before making any financial decisions. Thanks for listening, and we'll see you next time.